After weeks of speculation, the Federal Reserve just delivered what it had telegraphed: no change to the federal funds rate in July, leaving the door open for potential action in both September and December. "It's too early to say that we've reached a conclusive meeting," Jerome Powell said during his post-decision press conference. And Wall Street is already betting on 2 quarter-point rate cuts over the final 5 months of 2024, according to CME Group's FedWatch tool. So we're now at the halfway point of the Fed's likely last rate hike campaign, which began in January 2022. Along the way, it has impacted everything from our wallets, credit cards, loans, investments, the value of our homes. We looked at several categories where the long-running interest rate pause may be starting to have an impact on your bottom line. Let's start with deposits, the place where many of us keep our everyday money. The interest you earn on these accounts is either meager, or in the case of checking accounts, non-existent. In the current environment, you'll need to put some work in to make the most of your cash. How the interest rate pause affects your checking and savings accounts. You probably do. You won't think about your checking account much unless it's to make sure there's enough money in there to cover your next rent or mortgage payment. Otherwise, it's a cash-in-motion machine. You write checks, you swipe your debit card, you authorize automatic withdrawals. The convenience of having that money readily available limits its earning power. The national average of interest paid on checking accounts remains at 0.07%, according to the National Bank. Checking accounts are designed to be fluid. They aren't places to keep money parked for any length of time. Savings accounts, on the other hand, well, they do pay a little bit better. Interest rates on savings accounts are holding steady at 0.38% on average. That's according to the National Bank's most recent survey of deposit rates in June. Still, that's not where most people keep their serious money. There are ways to earn a better return in the current environment, even on cash. We like high-yield savings accounts. Some online banks are paying 4% or more. Ally Bank is paying 4.2%. Discover Bank is paying 4.1%. While these accounts typically have fewer bells and whistles than what you do get at a big national bank, they can help you maximize the return on your cash while still giving you easy access to your money. Here are some of our top picks for the best high-yield savings accounts. Money market accounts. If you have more like $10,000 or more that you want to keep on the sidelines but nearby, money market accounts can be convenient. These accounts often offer check-writing privileges, access to your money via debit card, and sometimes even compound daily. Nationwide average payouts on money market accounts remain at 0.59%. according to June data from the National Bank. So there isn't a lot of incentive to keep your cash parked there. However, you could find a high-yield money market account paying closer to 4%. Again, you'll need to do some research. We have a list of the best money market accounts paying right now. CDs, certificate of deposits or CDs, are fixed-term savings vehicles with banks or credit unions. When you put money into a CD, you agree to keep your cash there for a set period of time. In exchange, the bank or credit union agrees to pay you a set interest rate. As the Fed pauses its rate hikes, CD rates haven't moved much lately. The average 12-month CD is paying 1.63%, according to the Federal Reserve's H41 survey of rates on June. But you can find better deals if you're willing to shop around and maybe park your money in a bank that's not in your time zone. Term and minimum deposit requirements vary by institution. For example, you may need to put $10,000 into a CD to lock in a higher rate or commit to a longer term. Dig into the details before plunking down your cash. We've got a list of the best CD rates paying right now. Now, let's talk about the rate pause's impact on debt. For those of you carrying a balance on your credit card or looking to finance a big purchase, higher interest rates may be putting a squeeze on your budget. The good news is that we're seeing some relief in this area. We looked at credit cards, mortgages, and personal loans, 3 kinds of debt that can make a significant dent in your monthly budget. Credit cards. Credit card issuers typically set introductory rates for purchases, balance transfers, or both. After the promotional period expires, your rate will adjust based on your creditworthiness and the prime rate. Prime rate is the interest rate that banks charge their most creditworthy customers. It's currently 7.5%. People with excellent credit who take advantage of introductory offers can get 0% interest for 6 or more months on new purchases or balance transfers. On the other hand, people with fair credit or lower may see rates of 20% or higher. Overall, the average credit card interest rate is 22.36% according to the Credit Card Monitor. In this environment, it's especially important to pay your bills on time. Doing so avoids late fees and helps you build your credit score. Plus, if you carry a balance, you'll be less likely to fall into the trap of only making the minimum payments and paying exorbitant amounts of interest over time. Home mortgages, and then there are mortgage rates. Let's get this question out of the way. When will mortgage rates go back down to 3%? Whenever the Fed does cut short-term interest rates, it may not be enough to budge mortgage rates all that much. Those are more influenced by the bond market, particularly the 10-year Treasury note. Housing industry analysts with the Mortgage Bankers Association, Redfin, Realtor.com, and Zillow expect mortgage rates to remain in the 6% to 7% range through the end of this year. The average 30-year mortgage rate was 6.87% as of July. According to Freddie Mac, a year ago, it was 5.78%. Want to know more about how rates work? Check out our explicable on mortgage rates. Personal loans. Personal loan interest rates have been lingering near 12% for nearly 2 years. They were around 9.5% for 3 years, from 2020 to 2022. Taking out a personal loan is generally a bad idea when you can get a better deal elsewhere. For instance, a personal loan typically won't get you a lower rate than a car loan, which is why it's rarely a smart move to use a personal loan to finance a vehicle. We'll wrap things up by talking about how the Fed's actions and statements impact your investments. In general, rising interest rates tend to weigh on stock prices. With the Fed signaling that more rate hikes are on the table, investors are digesting the possibility that borrowing costs may rise further. On Wednesday, the Dow Jones Industrial Average fell 1.26%, the S&P 500 dropped 1.64%, and the Nasdaq Composite declined 1.97%. While short-term treasuries are paying some of the highest yields we've seen in 2 decades, they still offer decent returns in the grand scheme of things. 2-year treasuries are yielding about 5.1%, and 5-year notes are paying about 5.6%. If you're considering buying bonds, keep in mind that bond prices and interest rates have an inverse relationship. So if you buy a bond at a time when rates are expected to rise, you may not get the full face value of your investment back. That being said, bonds can be part of a well-balanced portfolio, and they can help reduce volatility. The Fed rate decision is just one factor influencing your wallet and the economy. Consumer spending and inflation also play key roles in shaping the future of interest rates. To learn more about the factors that can influence future interest rates, subscribe, like and comment to watch a new video when they come out. Thanks for watching.